Lower economic growth, higher borrowing costs, and a diminishing purchasing power for consumers. That's what the South African Federation of Trade Unions says will happen if the inflation target is lowered to 3%. He warns that with sluggish growth prospects for 2025, the move would set back any economic progress to ease the unemployment rates.
The economy already plagued by catastrophically high unemployment. Reducing the inflation target will hamper job creation, lead to high indebtedness, and generally an unviable economy. Purchasing power will also be affected, leading to low consumer demand and therefore low economic growth.
However, the executive director at the Center for Risk Analysis says Treasury and the Reserve Bank singing from the same hymn book is a good thing, adding that the country has trailed behind other emerging markets in lowering its target from the current 3 to 6%.
Overall, it's the right kind of thing to aim towards. How we get there, though, and whether it's sort of very much over the long term and not just the short term, I think sort of bull in a china shop kind of way, I think it could be a good thing.
But he warns that there are several economic risks outside SARB's and Treasury's control that could impact how soon a 3% inflation target is implemented.
That's things like the international oil price. It's the strength of the dollar, where South Africa imports a lot of fuel. So we're quite reliant and exposed to international oil price increases that then feeds into domestic economic activity, manufacturing, etc., etc.
Meanwhile, Old Mutual Group chief economist Johan Els expects the Reserve Bank to hold interest rates on Thursday and doesn't expect any further interest rate cuts before 2027, but also doesn't see any hikes on the horizon. For Newzroom Afrika on Channel 405, I'm Ntokozo Khumalo in Johannesburg.